2025, I saved my average client in income taxes saved $145,000. This is better than any of my competitors, even some billionaires that have tax firms. So how do I do this? And the way that we do this, there's two different types of categories that I split people up into. There's W-2 clients, they're just W-2, they got, their bonuses, their wage, their RSUs, their ESPPs. And then there's people who are self-employed or they own businesses like corporations. And we have two different strategies and two different approaches because there's different tax rules and different laws. So let's go through this. How did we save this much in taxes? What most CPAs and tax strategists, which isn't even a real term, if you're working with a tax strategist, good job, good luck. They're not even gonna get a job in corporate America. But what most of them fail to look at is we wanna do what's called adjusted gross income planning. Why do we wanna do adjusted gross income planning? So if I have a client that has an adjusted gross income of $700,000, I'm gonna say, hey, if we together through tax planning can get your adjusted gross income down to $400,000, you will now get more tax credits, things that are available to you, different thresholds, different state and local deductions that you otherwise would not have been able to do because you were phased out. So you want to look at all of the phase out rules and get yourself underneath. There is a million of these phase outs. I do not advise you do this on your own because it is a constant algorithm calculation and it is not as black and white. And this is why most people don't save their clients as much money because they don't focus on this one line. This one line phases out a lot, as does taxable income, QBI and stuff like that. So we want to look at this because that's going to affect everything that goes on underneath adjusted gross income. So that is one thing that I have always focused on. And I will tell clients, if you invest an extra $62,500, you will get under this threshold, you'll get the kiddie tax credits, for example, because you have 4 kids, get the $8,000, it's free money. Duh. Plus you're gonna get income on the back end. So that is the main key thing that I do for W-2 clients. Anybody who's on a 1040, we always wanna focus on this because it's super important that we make sure that you're getting yourself under those phase out limits if we can, pending your lifestyle and amount of cash you got to invest. This is why they always say cash is king. So don't go pissing your cash down the drain. The other way we did it was through oil and gas investments. In 2025, oil and gas investments got bumped up to 100% 59E intangible drilling cost deductions. They also were given 100% bonus depreciation for tangible drilling costs. So all of your oil and gas investment, dollar for dollar, you're officially getting 100% deduction on in 2025. That carries into 2026 as well. The other thing I sent a lot of my clients to invest in who had real estate professional status and could qualify, I sent them to senior living facilities and storage. I like storage because there's a lot of cost segregation. I like senior living facilities because you're buying a business with real estate, so it's not really real estate, so you can fight the business angle. Some CPAs will say it's a business because you're buying into something that is performing a service rather than the focus being on real estate. So I like these two because they both qualify for SBA loans. When they qualify for SBA loans, they have to be a business. So you can get yourself out of this real estate professional status if your CPA agrees. I am really good at convincing them, so we like to invest in these because they're businesses. So these give a lot of deductions because they have cost segregation, they have expenses when you buy them, anything that's an asset. Senior living facilities, the beds, the windows, the lights, the doors, all can be deducted and they're really important, so you get a lot of depreciation out of it. The last thing that we did was we focused on people that were self-employed. So I guess different tax credit studies, we'll just add this in too. Tax credits. If you have a business that's self-employed and you're paying yourself a W-2, the business is paying for your health insurance, you can get tax credits for that. most people don't look at tax credits. They don't pull things. If you're heavily veteran ran, if you're very heavy in all of these spaces, you can get different tax credits for all of this. So tax credits, the easy one is insurance when you're self-employed. The other one is veterans. That's another big one. Anything that the government really wants to support, there's tax credits for. So I always, opportunity zones, those are another great one. So there's a bunch of tax credits that we looked at depending on where my clients were. Just did a quick check and got them some tax credits because those are dollar for dollar. These ones are above the line, so you have to affect it by your tax rate to see what you're saving, your highest tax bracket when you're W-2. When I worked with self-employed businesses, in the business, we do the planning. So this is 2 plans because we're planning your W-2 plus we're planning for your business. So we're teeter-tottering. The other thing that we look at is, one of the key things that we look at is captive insurance. Setting up your own insurance for health, business, cybersecurity, whatever those are. If you want to learn more about captives, I do a video on risk mitigation. Go check that one out. It talks about why we like captive insurance. It's a great way to stuff money away in something that's tax deductible. My health insurance, if I have a deductible or co-insurance, I bill anything that my health insurance didn't cover. Anything over and above, I bill to my captive. My captive reimburses me, so it's in reimbursement of an expense. There's no income. The other thing that I do is I look at defined benefit retirement plans. Defined benefit retirement plans, those are like the OG pensions back in the day. You can get a lot more into your retirement plan through a pension than you can through a core 401k that's a contribution plan. And so I like doing these. We are able to get up to $350,000 per person away, depending on their wage, their age, and different variables, how much money they're making in their company. So these are a great way to stuff money away, and a great way to shelter your taxes. And you can get 6 figures in deductions, which most tax planners are focused on 5 figures, which not going to help you when you're making millions. So the third one that I use is if you as a business don't have an office and you're paying rent, I'm going to tell you go buy a commercial property. So here we have cost segregation on real estate purchased, so that you don't have to pay rent, you pay rent to yourself. This is a great way to keep the money in your own ecosystem and buy a building. Commercial property appreciates at a higher rate than other, like single family. You can also get a building with like 4 offices or one of those homes. I've seen people buy the homes on the main boulevard and convert it to an office and put up 4 walls and 2 walls to cut it into 4 units, different doors. And these make a lot of money. I've seen people take condo office spaces and chop them up into like 600 square feet and rent them out and make boatloads of money. So there's a lot of ways through business and through self-employment that you can get these kind of assets, and you can really start to like make a lot of money. And cost seg would help in that. For C Corps only, this is why I like C Corps, because they have their own rules. We did a lot of executive bonus plans. So we hold a board meeting, we approve a new bonus structure, an executive bonus plan, we put together paperwork, we do reasonable comp analysis, we do a bunch of work to get these done. And we love executive bonus plans for solopreneurs and people who are trying to retain, like if you have a number 2 or number 3 that you want to retain, you want to give them an executive bonus plan, you can take up to $1 million in deductions for an executive bonus plan. It's tax deductible. So these are a great way to keep and retain your employees and get lots of tax deductions if you have a very, very, very big business. And yeah, so if you're making over $250,000 and you want help with your tax planning, click the link below and schedule a call. Happy to help you with any of this and hopefully bump my numbers next year up from $145,000 average save to my client.